There's a reason some Canadians retire with seven-figure RSPs and still end up paying less tax than people who have much smaller ones. And it's not because they're using loopholes, it's because they're using their RSP with intention. They're not treating it like a one-size-fits-all savings account. They're planning into the future. The difference isn't how much they contribute, it's when they contribute, when they withdraw, and what they're doing with the money once it comes out. The strategies they're using, they're available to everyone. They're just rarely explained in a way that makes them actionable. Hi, I'm Aid McDermott, Associate Financial Advisor here at BLA Private Wealth, and if you've been diligent about contributing to your RSP for years, you probably understand the basic concept. You defer tax today, and you pay it later. But what separates a basic retirement plan from a truly efficient one is understanding that later isn't one moment. It's a series of decisions spread across your whole retirement. When we build financial plans for clients, we're not just looking at how much is in their RSP. We're looking at withdrawal sequence, spousal RSPs, tax bracket management, and estate efficiency. And we're often planning for those things years before retirement even begins. The earlier you start thinking this way, the more flexibility you have when it matters. This isn't about offshore structures or aggressive tax strategies. These are straightforward strategies built directly into the Canadian tax system. They just require some planning. If this video is helpful, don't forget to like, leave a comment, and subscribe. And if you'd like a second opinion in your own situation, you can always book a time with me using the link in the description down below. Let's start with strategy number 1. This is the spousal RSP, and it's used for long-term income splitting. This is income splitting that starts way before retirement, and here's how it works. If you're the higher earner in your household, instead of contributing only to your own RSP, you can contribute to a spousal RSP in your partner's name. You still get the tax deduction today, but the plan is registered in your spouse's name. What does this mean? Well, when we fast forward to retirement time, when your spouse withdraws from that plan, the income is taxed in their hands. And if they're in a lower tax bracket, you've shifted income from your high tax rate down to their lower one. This is the same contribution you're doing anyway, the same deduction you're getting, but very different tax treatment, sometimes decades later. The key here is understanding the attribution rules. If your spouse withdraws the funds within 3 calendar years of your last contribution, that income gets attributed back to you for tax purposes. But once that 3-year window passes, the income is theirs. So if you're planning to retire in, say, 10 years, contributing to a spousal RSP today can give you much more flexibility in retirement. Strategy number 2 is strategic early withdrawals. Conventional wisdom says leave your RSP alone as long as possible to maximize tax deferral. And sometimes that advice makes sense. But when we model this in client financial plans, that strategy can break down quite quickly if the deferral simply means you're facing higher tax rates later. One alternative approach is taking withdrawals earlier and intentionally before you're forced to. Let's say, for example, you retire at 60. You're not taking CBP yet, and you're not taking OAS yet. Your income has dropped significantly. This creates a window where your marginal tax rate may be lower than it's been in decades. And instead of waiting until age 71 when mandatory RRIF withdrawals begin, you could start drawing from your RSP earlier. You'll deliberately fill up those lower tax brackets, and in some scenarios, you can take out $30,000, $40,000, or even $50,000 per year simply because the tax rate is lower. If you don't need the cash, the money can be moved into your TFSA or a non-registered account. That way it can continue to grow, but the difference is you've already paid tax at your lower rate. This strategy is sometimes called tax bracket arbitrage. You're choosing when to realize income based on where you pay the least tax, not when the CRA forces you to. So strategy number 3 is maximizing the pension income tax credit. As soon as you turn 65, $2,000 a year of pension income can qualify for the income tax credit. RRIF income qualifies, annuity income qualifies, but RSP withdrawals do not. So here's a strategy worth considering. If you're 65 or older and you haven't converted your RSP to a RRIF yet, think about converting a portion of it. You don't need to convert the whole thing. You can just convert a small portion, withdraw $2,000 per year. Yes, that withdrawal is taxable income, but the pension tax credit will offset the tax entirely. This allows you to pull $2,000 per year from your RSP fully tax-free. And the best part, if you're married, your spouse can do the same thing. That's almost $4,000 per year coming out of your RRIF with little or no tax. Over a 20-year retirement, that could mean roughly $80,000 leaving your RSP without significant tax. It's a small strategy, but over time, it can add up. Strategy number 4 is estate optimization. Something we often see when reviewing clients' estate plans are older clients with very large RSPs or RRIF balances. When there's no surviving spouse, that balance is typically fully taxed as income in the year of death. This can mean 40 to 50% tax rates at the estate level. The one strategy some clients consider is gradually drawing down the RSPs during their lifetime. They accept the tax while they're alive and when they have control over the timing and their rate, rather than leaving a very large balance that triggers a large tax bill for the estate. This doesn't mean emptying your whole RSP at 65. It means being intentional about your withdrawals throughout retirement so you're not sitting on a very large RRIF balance later on in life. Don't get me wrong, the RSP is one of the very best wealth building tools available to Canadians. But building wealth and preserving wealth are two very different things. Contributions get you to retirement, withdrawals determine how much you actually keep. The strategies we discussed, they aren't theoretical. They're used every day by Canadians who understand that tax efficiency isn't just about what you earn, it's about how you structure your income over time. When we model different scenarios for clients, the difference between withdrawal strategies over a 20 or 30-year retirement, they can be significant. Marginal tax rates vary dramatically depending on income, province, and timing. Over decades, even small tax differences, they can add up. Thoughtful planning may help you preserve more of what you've built. And if you'd like a second opinion in your own situation, you can always book a time with me using the link in the description down below. Thanks so much.